Technology Services is also in focus. It's reported an in-line operating performance in the third quarter. Company's updated its FY25 revenue guidance to near 10% compared to 8 to 10 earlier. Let's talk about this more. Amit Chadha is Managing Director and CEO at the company. He's with us. He's also the NASSCOM Executive Council member. Amit, good to have you with us here. Thank you very much. Your FY25 revenue guidance of 10% now includes an acquisition. Can you share what the organic growth guidance is for this year?
So the organic will be at that 8% level, and with Intelli will come to that 10% level. So that's how you should see it.
Right. Fair enough. So organic growth of 8% for 25 would imply a Q4 revenue growth of 7% on a sequential basis. What makes you confident of achieving this?
So thank you for asking it. So number one, I should say that we don't give quarter guidance. So I haven't, I'm sure I've done the math, but I'll stick to my annual numbers, and whatever that comes out to the quarter, that will happen. Now, why am I confident? Number one is that if I look at our pipeline, I've talked about it in the past as well, our pipeline is better than what it was the same time last year as well as last quarter. If you look at the number of deals we've closed, this is the highest number of deal wins that we've had in the recent past, right? If you look at it, there's been 8 wins. So there's been a 50 million win, there's been 235 million wins, there's been 25 million wins, and there've been 10 million wins. And these all go into revenue realization in the current quarter. Some of it came through last quarter, but the rest of it comes this quarter onwards. If I may just take a minute and talk about a couple of other things. See, we've been investing all throughout in AI, Gen AI. We stand at more than 175 patents now in that area alone. The company has yet again filed 50 patents in the current quarter as well, overall total. So the technology push that we've been giving is starting to pay off for us, and we are seeing deal conversions. In fact, the medical deal that we won, the industrial deal that we won, and the media deal that we won, all three of them we've actually sold. Part of the service offering has been to sell the packaging of our reusable assets and AI, Gen AI as well, right? So that will help us as we plow through next quarter and beyond as we grow.
Hi, Amit. Your FY25 organic growth of around 8% is at the lower end of that 8 to 10% guidance. Would you say that there is some downward assessment to your organic guidance? And also you had a margin guidance of around 16% for FY25. Maintain it?
Sure. So if you look at it, we gave a band 8 to 10, right? When we give the band, we can come in anywhere in that band, right? So you can't assume that you'll always be at the upper end. And this has a number of factors. This has decision making, this has deal velocity, this has the overall demand environment, etc. As I see today, the demand environment is definitely better today as opposed to the same time last year. I see the pipeline to be a lot bigger than what it was same time last year. And I do see the green shoots coming out, and therefore FY26 being a better year than FY25. Having said that, there is a little bit of, revenue to be sold in the year baked into these guidance numbers that we always give. And that's where we are. Now, in terms of margins, we had committed that H2 will be better than H1. So if you look at it, our 15 odd levels that were there in Q1 and Q2, in Q3, we've come in operationally at 16.x. And then if we take the M&A charge, small charge, it comes down to 15.9. But I'd stick to the 16.x or 16.2 that we've got. And I do see quarter 4 EBIT coming in at similar levels. In fact, the Q2 operational EBIT of 16.2 is after 100 bips spent on increments in the current quarter for the employee base. So we are back operationally, as you can see, because our investment phase is kind of the jump investment quarter 1, quarter 2 is over. It will be regular investments, and you will continue to see margins improve. Medium term, we are reiterating our aspiration to get to $2 billion and 17 to 18% EBIT levels.
17 to 18% EBIT in the medium term. The market is liking what you're saying, sir. So once again, just to reiterate, the near term, what you're saying is that in Q4, margins will sustain at the Q3 levels of around 16%.
In that neighborhood, yes, you are absolutely right. And from there on, you will see the organic growth and the organic margin should continue to improve and climb from there. Because we have invested, like I said, in reusable assets. We are automating a lot more. There's a pyramid correction that we have implemented. In addition to that, we will be taking in about 2,000 freshers in FY26. So all of this will come into play, and we are working on improving the offshoring ratio as well. So you will see all that positives coming in as we move forward.
Okay, so you're very confident on margins, got that point. Speaking of offshoring, I mean, that's the next big chatter, right? What happens to immigration policy in the US? What is your current offshoring ratio, and what scope of improvement do you see?
So we are in that currently our range, and I don't have it off the top of my head. I think we are at about 41% on-site, so about 58% odd offshore right now. And we should be able to, again, in the medium term, this 58 odd percent can go up to about 65, 68% for sure.
Okay, all right. Amit, you mentioned that FY26, will be better than FY25. What are you hinting at? Should we assume a double-digit growth?
That will be the aspiration, but I don't want to give out a guidance right now. Please allow us to come back in April to you. Things will shake out and be a lot more clearer. But you will have, Intelli's 3 quarters coming in, because we've integrated that on 3rd January. So a quarter of that will come into quarter 4 of ours, and then the remaining will come into 3 quarters for next year. So that's how you should see this. In fact, I do want to make a couple of points here. One, we will be able to, with IntelliSwift, be able to take 3 of our hyperscaler accounts and move them to 20 million plus immediately. Second, we were not working in the service-led ER&D space, and that opens up for us. So fintech, retail, healthcare are 3 areas that we'll additionally start to serve. And I do believe that will help us grow faster and further as we move along.
Right. Amit, did the 3rd quarter benefit from bunching up of deal wins? And is this deal win run rate sustainable?
This was the highest growth that we have had. This is the highest deal wins that we have had in the current, in this quarter. And I do believe that going forward into quarter 4 and beyond, we will try to keep this pace as we move forward. Our pipeline is a lot better than what it was last year. And we do believe that the differentiated solutions that we have and our accounts are starting to grow. So next year, you will see our first 50 million account and then beyond. So you will see that expansion coming, and all this should help us.
Okay, just to wrap things up, I mean, some more color. Mobility was under pressure. Why is that? What's the outlook on other verticals? Just leave us with the big picture.
So mobility for us is auto, trucks off highway, as well as aero and rail. In the current quarter, I had said when we gave our results out last quarter that mobility will be soft, and there was an account of furloughs, as well as a couple of automotive, automotive spends are under stress. So keeping all that in mind, we had made that commentary. I would like to confirm that next quarter onwards, mobility will start to grow again. And this will be on the back of the deals we have won on this quarter, as well as some of the solutions we created on LTTS iDrive, which is our software-defined vehicle solution, and based on the fact that Aero and Rail should grow. So with all those 3, you will see mobility starting to expand next quarter onwards again. So just take this 1 quarter as a one-off. Now, if I switch subjects and go to sustainability, which is our highest profitable segment, that grew at 4% quarter on quarter, 8.1% year on year on a sequential, constant currency basis. I do see demand in sustainability to continue to be there. In fact, we won deals in the current quarter, and we've got a good, healthy pipeline to close in quarter 4 in sustainability as well. There's a couple of very chunky deals, and that will help us. In fact, maybe our first 50 million account will come from sustainability itself. And you will see that continuing to expand as we move forward. We are seeing demands in rejigging of supply chain and industrial automation, as well as AI in automation in the shop floor. Finally, the tech segment, which actually grew about 11%, was fueled by medtech, as well as hyperscaler revenue, CMT, that came into us. And on the back of the deals that we won this quarter, we do expect next quarter to be the growth to continue in this area. So I'm fairly comfortable at this stage to say that all three segments will grow next quarter as well as continue to grow into next year.
Okay, all right. We will leave it on that note. Thank you very much for joining in, Mr. Chadha, and good luck to you for the rest of the year as well. Need to take a very quick break, come back on the other side, and then we put the spotlight on the cement space. Earnings season is in full bloom. So what are the expectations from this major sector? Rajesh Ravi of HDFC Securities will join in. Of course, Nigel is going to run us through the key expectations, quarter se quarter tak.